We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners and Burke Britton Financial Partners. This is episode number 97 of the Finances podcast. Today's guest is Lee Wisniewski.
Nailed it.
Well, you put it phonetically on your notes, so thank you for that. Lee is chief broker and owner of Fidget Finance, a boutique mortgage broker business based in Geelong with the clients Australia-wide. Lee, thanks for joining us. Now, Delta, maybe it's best if you do a little bit of backstory and intro on how you know Lee, because it was your connection with Lee that led Lee to coming on the podcast today, and then we'll hand back to you, Lee, and you can tell us a little bit about your backstory.
Thank you.
So go for it, Delta.
Absolutely. Thanks, Jay. So, welcome, Lee. Our history goes back about 10 years, it must be.
Yep.
Yeah, so you were running boot camp Geelong with your beautiful wife, Jess, and I joined boot camp and was up at those crazy 6 a.m. sessions down at Eastern Beach and Torquay and everywhere else. And, it sort of came about from that connection.
It did. Yeah, 10 years ago. Different life, it feels like now, but, 10 years. So
From fitness to finance, it's let's go back there. So let's go back to the mean streets of Werribee, as you called it.
Yeah.
Let's start there and work our way through boot camp to then Fidget. So you grew up in Werribee?
Yeah, I did, yeah. So I grew up in Werribee, Hoppers Crossing, and then built our first home. So my wife and I celebrated our 19th year wedding anniversary this week. So that's pretty exciting. And we bought our first block of land in Wyndham.
Okay.
And we built our first home there, of course. And then one day down the track, Jess was working at the TAC, and the TAC moved to Geelong. So they decided to relocate us, and we were happy because they paid for a house deposit and some stamp duty. We were like, how good's this? So, we moved to Geelong, and that's, that would be 15 years ago. So we're in Geelong for a little while.
Sounds like your first experience was buying a house. Surely something else happened between when you were born in Werribee and you bought your first house in Wyndham Vale.
Yep.
What was growing up like in Werribee?
Yeah, I repressed that. Thanks, Jay. No, that's okay. Actually, you know what? It was actually a really cool time. I learned a lot. I learned basically how to speak to all different types of people, which is great because Werribee's pretty diverse, even more so these days. Mm-hmm. And the school I went to was in a like a housing commission area, but it was really great because you got to see all different types of people and experience different relationships. And I guess all through school, I didn't know what I wanted to do, and I thought I was going to be an army officer. That was something I was set on, and I am colourblind.
Yep, join the club.
Yep, there you go. So I'm colourblind, and they decided to remind me of that. I knew I was colourblind. I thought it got better, Jay.
Yep,
didn't get better.
Did you? Did the army officers come to the school?
I think they did. Yeah, we had the Defence Force. Yeah.
Okay, and was that where the inclination to join the forces or the armed forces was, or was there some other inclination?
Yeah,
did you watch Rambo?
Yeah, I watched a lot of Rambo. I knew I wasn't going to be Rambo, though, let's be clear. But I realised that I wanted to work in leadership, working with all different types of people. I played basketball and lots of team sports. I think I captained nearly every team sport in school.
Humble brag.
No, hang on. But I was crap at most of them. So it wasn't my skill that got me that. It was more the fact that I got people up and about and was able to bring people together. So I knew, leadership's something I'm passionate about, and bringing people together. And I thought that would be a really cool gig, get to be active and working with a bunch of mates necessarily in the army. And that didn't happen because I did the test and they said, you could be a fighter pilot with these scores, but you're colourblind, so you can't.
Oops. So, how'd you go? Yeah,
so that crushed that dream. And then from there, Jay, I decided that I wanted to, someone said, you'd be good at sales. So what can I sell? Houses are the biggest thing I could sell. So I asked the real estate agents, can you give me a gig? No, you're 18, forget it, kid.
So this was straight out of school? So you finished your 12?
Yep, finished your 12. Yep.
And tried to get a couple of work experience gigs at some real estate agents, and they said, piss off, kid?
Correct. They said, have you bought or sold a house? No, we can't help you. And I was a bit never to be shut down. I said, all right, what else can I sell? How about cars? Now, I don't like cars. I'm not into cars. And I decided to sell them because I thought I'd be good at sales. I get to meet all different types of people, same vibe. And I started in the car industry, selling cars when I was kind of like 19. And then eventually realised the guy in the corner office was in the suit, was working the same hours as me, and he had a nicer company car and seemed to be making more money. So, hey, why don't I get into that gig? So I started finance from that point. So,
Yep. And did you go to uni after school, or was straight into the workforce? So it was straight just getting work experience,
yeah.
car yards, finance. And when was your first finance gig?
Yeah, it would have been maybe 23 years old. So I worked in finance at the dealerships. They gave me a shot, and I did quite well at that. Probably 5 years working every single Saturday. It was a bit of a grind because I'd already done the yards and selling cars. So, we're talking probably 7 years by that stage.
At this stage, you're still in Wintervale. You hadn't moved to Geelong?
I was driving, to Essendon, and we'd moved to Geelong. I was working at Blood Toyota in Geelong. And in 2008, I had a brain hemorrhage out of the blue. And it was pretty shocking. I was living in Wintervale at the time. And Jess was asleep on the couch, said, I've had this headache for 2 or 3 days. I'm going to go to the doctor. So I woke her up. She said, do you want to actually still go to the doctor? Because you haven't got a headache anymore. It just went away. I said, I probably should. So I went to the doctor, and the rest is history. A day later, my head's open on an operating table, and it made me reevaluate. Do I really want to be doing this every single Saturday, grinding it out in an industry which I loved the people in there, and I loved what I was doing, but I didn't love the car industry because I'm just not into cars. So I left there and worked as the BDM, or an account manager, for an insurance company that was essentially going around teaching people how to do finance and insurance at car dealerships. So I thought that was great. Didn't work weekends, got to travel around a lot. And that's kind of why I moved to Melbourne. So after a few years, I ended up in Melbourne and focused on my, insurance career, and just realised this is also still in the car industry. I've really got to have another crack here, and I've got to get back in finance, but in property. And I decided to make the jump.
So what year was that? What year did you actually decide to make the jump into pure finance property? 2015.
Okay.
Yeah. And so what was that? What was your first gig in property finance lending?
Yeah, so I'd moved to Melbourne. I mentioned before, the boot camp that Delta was talking about before was a side project because we just loved it so much that we decided to take it over when people stopped running it, that were running it before. And we had to rebuild it, but it was on the side. So it was taking a lot of time and effort, and I got a promotion in that role and I had to move to Melbourne for it with that state manager of that insurance company. So when I moved to Melbourne in 2015 or 2013, after a couple of years, I said, I miss Geelong, but before I came back, I set up a loan market franchise. So I just jumped out of the industry straight away, big, high-paying, cushy corporate role in management, and said, if I don't do it now, I'll never do it. This was pre-kids, and became a loan market franchisee. So that was, 2015, when I was in Melbourne. And then, a couple of years later, I said, I just miss Geelong. I'm coming home. So,
isn't it amazing that those sort of setbacks you've mentioned, being colourblind and the army and then, a major medical event really changed the trajectory of your career and where you chose to, focus your time and energy after that?
Yeah, absolutely. So.
What do I say, Delta? Peter tells us all the time that crisis creates opportunity. If you look for it, it's there somewhere. So 2015, a loan market franchise. Was it just you? Like, how hard was it to get a loan market franchise license, and what was the progression from there?
Yeah, it was just me. It's not very hard to become a mortgage broker, as in to walk up, start
your certificate.
Yeah, that's right. So it's not, and the barrier to entry is very low. And this is not to have a dig at anyone listening to this or watching this. This is just saying that you could be driving an Uber on a Friday, and in a couple of weeks' time, you could be doing a certificate to become a mortgage broker. And back when I started, you needed to get your certificate in finance or mortgage broking, and then from there you had to get a diploma. But you had, I think, 12 months. Could be corrected, but 12 months in which to get your diploma, and you had to have a mentor for 2 years. But mentor doesn't mean you're working in a practice with a mentor. It could be a paid mentor or one provided by your aggregator. So the barrier to entry was actually pretty low, and it may still be. I don't really know the exact at the moment. But yeah, it was not too hard to get in. But the challenge is, you're jumping out of a job into no income, essentially. And even if you find clients, you've got 3 months or something before you actually get $1, because there's a lead time. between doing an application and getting paid. So the barrier to entry may be low, but who can, especially in today's climate, just leave a job and have 3 to 6 months bankroll to get before you get paid?
I think it's not only that, not only the lag time in terms of income payment, but the lag time in terms of knowledge too.
Yeah.
Interesting, in our industry, there's obviously been a big push in sort of financial planning world to, like, you could literally get your license to provide financial planning in a Wheaties box back when I started.
Yeah.
And that progression, I mean, Delta is now one of the most qualified people that we have in the practice, having done a Masters of Financial Planning, and the barrier to entry is different. But irrespective of the certificates and qualifications, the thing that I think stands businesses and individuals apart is their experience, and they're willing to sort of the curiosity to actually want to learn, because again, anyone can be a mortgage broker, and probably nearly anyone can be a financial advisor, but being a good one, what sets a mediocre mortgage broker or financial planner apart from a great one is that experience, the curiosity, and the care that they actually have for their clients. So it sounds like it's kind of ingrained in you to have that curiosity and leadership and interest in people.
Yep.
But talk us through from you being a sort of a sole trader franchisee to where we are today, the progression of your business to where you are today with Fidget, and what your business looks like today after, nearly 10 years of mortgage finance.
And especially early on, because the learning curve is pretty great. And when you're geared like me, you don't want to just chill out. And besides, I was living in East Melbourne. Rent wasn't cheap. My wife was working, but she wasn't in a role like she is today. And so there was a lot of pressure in that. We had a few months buffer, but it was up to me to kind of start really hustling. So, when I first started, it was just me, low market franchisee. When I moved back to Geelong, just before I moved back, I rebranded into Fidget. I always wanted to have my own brand because I realised that Loan Market is a wonderful aggregation company, but there's loans. Loan market is loans, and I wanted to be more than that. So we wanted to be able to help add on other services to our business, which it was a great idea at the time. And the name Fidget essentially got created because I found that most of our clients at the time didn't sit still. They wanted to move house, curious about moving lender, and no one tended to be idle. And I thought, well, I want to help facilitate that. So that's where it came about. So the name Fidget, we rebranded, and then when I came back to Geelong, I was Fidget. And I realised that over a couple of years there, the better I got at my job, and the more people realised that I have a genuine care and interest in serving people with the knowledge that I built over 15 years in finance, they realised that, hey, these guys can get stuff done. I trust them. So I'm going to introduce my friends and family, which is a beautiful problem to have. However, it puts a lot of pressure on you as a business owner, especially when you're a small business, because you got everyone at you to they want to use your services, and the busier you get, the more you are really getting tested on your systems and processes. So a few years ago now, we had to take on some extra support staff and reinvent the processes inside of our business. So I'm a pretty analytical, anal kind of guy with process maps and flows and swim lane diagrams and making sure that the right people are doing the right jobs. So I guess what I'm saying is that it's not necessarily the numbers of the people in our business, because we've only got 3, but it's the systems and processes that make it hum. So we've got scalability now, which is great. I love it.
That was my exact point, that when you've got those things right, how easy is it going to be to slot in another broker, another support person with all the right systems in place, so everyone has clarity, and you can continue to have that really good problem where you've got lots of people coming to you that need your assistance.
Yeah, absolutely.
It's interesting. We'll talk a little bit about obviously lending, but one of the things that's obviously interesting on this podcast, we talk to a lot of small business owners, and obviously as a small business owner myself, very curious around some of those ceilings that small business owners hit when they realise that they can't just muscle through on their own manpower or woman power, and they actually need to have some structure. Those systems, processes. I had Chris Davies, who was previously CEO of EvoLogic. He was on a couple of episodes ago, and he's now working he works with a group called EOS, Entrepreneurial Operating System, where basically giving small business owners a framework to be able to build through. When you realise that you've done probably all you can do yourself, you go, okay, I actually need some systems, I need some processes, I need to have people with roles and responsibilities. I think that for any small business owner, it's such like anyone out there banging their head against a brick wall as a sole trader or as a small business owner, it's something that you talked about mentors earlier. Mm-hmm. I think it's something that I'd encourage anyone to do. Actually find people that have had success in business like yourself, or have gone through some of those trials and tribulations, and take the opportunity to pick their brain about how they went from being a business that's solely reliant on yourself to one that can then grow and expand and duplicate and scale, because that's the want of nearly every business owner. How do I scale beyond myself? So just on that front, and we'll jump into the lending stuff in a second, but in terms of the most pivotal thing for you in growing your business and getting to the point now where you've got a team that operates efficiently with systems and processes, what were some of those what were some of the key milestones in the business during the last 9 years, 10 years?
Yeah, so key milestones is definitely that. Processes, building that, and realizing that we had mini-me's in our business, and they're fantastic stuff and really great at what they do, but they were mini brokers who became great brokers, by the way, but they were all just like me. And at the time I was saying, well, we need an admin person to process loans, so you need to do this for the time being. And they did an okay job, but it wasn't their wheelhouse, and that was probably one of the biggest learnings for us, is realizing that if I just create a bunch of mini-me's who I'm mentoring, literally, as in on paper as well as presence-wise, that all we're doing is creating just this logjam still, because they're not the best people at the job. So the biggest turning points for us was just getting the right people on the bus. And once we had that process solid, it's like, okay, now we hire the person for the job and not just create a job for a person.
Can I ask, what support did you have around that? Did you have a system? Was there a book you read? Did you have a mentor?
Yep.
What was it?
I'd love to say it was a system or a book I read. It was just hard. I'm just that way natured, right? I just every time I looked at someone's business, and you mentioned it before about businesses that, everyone wants to scale. And when you look at other people's businesses, if you're that way inclined, sure, you are trying to pick apart all the best pieces of theirs, but if you put them all together, you got a Frankenstein, so you kind of need to find what process works do you want to emulate and just do that really well. So I was in big danger of just trying to plug in all these different ideas, and it just became a Frankenstein. So I went, you know what? I've got to find some people I want to emulate, and just go with it. Because not everybody, necessarily wants to build this huge team, and they're maybe not cut out for it either. So sometimes it's just staying in your lane, building these, processes so you can.
So how did you go about finding a person you could emulate? Who were they, and what did you like about them?
Yep. So I was people inside of our aggregation company.
Yep.
So essentially, what I did is I leaned on our BDM and said, "Hey, who have you got out there that you can fine tune a process with?" And he was also very process oriented. So we sat down together and mapped out this swim lane diagram. So I actually took a few months off. 2 years ago, I had my midlife crisis, so it's done now. It's behind me. But a few months off from the business altogether, where I partnered with another firm and they took over during that period, so I could reevaluate and say, you know what, I don't hate broking. I'm not burnt out. I just need to get better at these processes. So I spent 3 months, Jay, just sitting down there literally in a dressing gown in my office, doing process maps and making sure I had it nailed before I came back on the tools. And it's been a breath of fresh air. So.
Yeah.
What an investment to have 3 months off to work in the business rather than on it. We often refer to that as, sharpening the saw.
Yep.
So you can go back and be more effective when you use it. So,
yeah.
I imagine Jay sitting here thinking, that would be good to be in a position to.
I've got a couple of weeks off at the school holidays in a second, in a week or so.
Yeah, you've got 100 kids, don't you?
Yeah, there's nearly there. Yeah. I suppose the point I probably wanted to make there for any of our small business clients or anyone listening is that sometimes you can be afraid to reach out to people that you want to emulate. most people are welcoming of those inquiries, and if you're in the same boat as a small business owner, make sure you reach out for support. And when we're big on connection, big on making sure that there's someone out there that can connect you with someone who's got some experience that you could benefit from.
Yep.
And the best way to do that is to network and connect with people in your community and in your organisation, because there are people that are killing it and would be happy to share. So that's probably enough on the business side of stuff. Delta, do you have anything else on the Fidget business itself? Because that's, I think, what a lot of our listeners are keen to sort of hear about is your thoughts on sort of the property market, but the lending market specifically. Obviously, there's been we've been in one of the most unusual periods of time. It's probably unique in the sense that we did our second podcast we had a couple of years ago was called Russia Rates and Recession, and we talked about rates. And I don't think, I'm pretty sure our prediction on what rates we're going to do was totally wrong.
Yeah.
I know that in any of our planning historically, if we're borrowing for investment purposes, we're always factoring in, a 2% rise in rates for modelling purposes. And most of the time we'll say, and it's unlikely to ever happen. We're probably never going to see a rate rise of 2% in a short period of time. Well, it happened and some. So maybe talk through what you've experienced over the course of the since COVID, the rise and now plateauing of interest rates, and what sort of impact that's had on lenders and purchasers, and where you see that going over the course of the next short and medium term.
Yeah, sure. So you mentioned the 2% buffer. We know that's come and gone since COVID. That 2%, it's even beyond that now. And in fact, when you're borrowing money through lenders now, they're looking at a 3% buffer. So if you think about today, we've got 6% interest rates. 3% on top is 9%. Now, whoever's listening to this that has a home loan, they can probably work out very quickly that they can't afford 9% interest rates on their home loan. Most people, right? So people that are coming to us today saying, how much will the bank lend me? It's a very common question I get. And you'll say, well, the maximum bank will lend you is this, but you've got to be comfortable with the repayments. And a lot of people are like, look, I can stretch, I can make it work, I can scrape the bottom of the barrel to get this done. But they're the ones making the repayments. If rates do go up a few more times, they're going to be in a world of pain. So the big change in the last few years, Jay, is probably after the Royal Commission came about, there was a thing called the best interest duty, which was introduced to brokers. Essentially what it means is that the brokers have to do what's in the client's best interest. Now, that might sound stupid because morally we've been doing that since I've been broking especially. But not only is it moral obligation now, it's actually a criminal thing as well if we don't do what's in the client's best interest. So it can't be just what's in our best interest or a bank best interest. It has to be what's best for the client. Now, the reason I'm raising that is because banks don't have that. They don't have a best interest duty. So if you go into your local branch and say, I want to get a home loan, apart from the fact you're in the minority, because only 20% of people use banks directly these days, the rest are using brokers. If you go into them and you ask them for a home loan, they're not going to necessarily they don't have to do what's in your best interest because they just don't have the options. They've only got their product. So the best interest duty is a big change for us. It just further cemented our value proposition as a broker in the market. Interest rates definitely have been going up, as you mentioned before. The interest rates are climbing, and they're in the sixes at the moment for most part in owner-occupied and investment lending. And I was with Alan Oster, when I say with. So the head of the NAB senior economist was talking the other day at one of our aggregation PD days, and he said that they are factoring in a 0% chance of rate rises. So not 1, not 10, 0. And the reason is the global economy, in his opinion. Now, I don't pretend to know all the graphs and modelling, and that's his job. The global economy is in a bit of bother. That's an understatement. And we've seen, months now of essentially where we were in a per capita recession. So we've had, I think, 0.1% growth in GDP, which is not good, especially because we've got so many more people coming into the country. So, that tells you something. We've got heaps of people coming in, record highs, immigration, yet we're eking growth. And when you look at it per capita, we're technically in a recession, and we've been for a while. So I don't see a reason geez, I don't want to jinx this. I don't see a reason for them to actually increase interest rates.
We're going to replay this when you get you back on for another episode.
Yeah, don't worry. We'll just subtitle it so in some other language. So, no, I just don't see it. I mean, the Reserve Bank is saying interest rates could go up, but it's they don't want people to get loose again on spending, and no one really does. So of course they're going to say that. Whereas the Federal Treasurer is on the other side of the coin. So is the economist. So.
Yep. I think having had some of our investment managers on the podcast in the last couple of weeks, that is the general sentiment, that rates are not likely to go up.
Oh, good.
So you're on
Vindicated.
track there.
Yeah.
Well, for now, the future will be the teller of that. But I think it speaks a little bit to when you talk about how difficult it has been in property market, but also the market in general. And going back to what you said about the best interest duty, again, this is sort of old news. Anyone that's actually listened to this podcast, the importance of actually having people that understand your extended situation when they're giving you a product. You know, if you go to the bank and they say, yeah, we can get you a loan, but they know nothing. They know nothing about your extended situation. No. That's where the risk lies, is that if you don't have a helicopter view of someone's situation, you know the implications of their family, maybe, of their other investment situation, their cash flow needs. It's very hard to make sure, this is not defending the banks by any stretch, but it's very hard to genuinely have the best interest of someone at heart if you actually don't consider all aspects of their circumstances, which again is a huge plug for us and for you in actually having people that can support clients through those situations. But I can't stress it enough. Again, this is what we do every day, but it's why we add value.
And you mentioned there, Lee, a statistic around only about 20% of people go to banks directly. So that's the 80% that are coming to brokers. Have you seen that steadily increase in your time as a broker, or has there been a spike since rates have been increasing?
Yep. So pre-Royal Commission, it was in the 50s, somewhere around 50%, give or take, and now it's at 74%. So I rounded it up. But yeah, so I think it's 74%, and that's going up. And there's plenty of reasons for that. And I think the best interest duties no doubt helped.
Yep.
Because people do genuinely think that we're doing what's in their best interest. But also because it is, Jay mentioned before, it's harder to get a home loan. You need to know where to go with your home loan. There's the rise of digital lenders, and they're only going to fit a very small percentage of the population. And, if you're listening to this and you don't have the most cookie cutter financial situation in the country, it's going to be really, really hard for you to kind of navigate which lender is not only the best from, rates and terms, but is it going to get approved? Like, we at Fidget do not submit loans that don't get approved. It just doesn't happen, because we know when we submit it if it's going to get approved, because we've got 400 pages of lender policy for each lender, and we know where it's going to fit.
You've done all the due diligence. You're not submitting it until you've got that confidence that it's going to get the tick.
That's right. Yeah.
The idea of actually knowing how to submit a deal. I mean, people, and we're talking about this, I think it might have been yesterday. Wasn't in a podcast, it was with an accountant. We were talking about the art of actually putting together a deal. Yeah. And knowing, it's not going to get approved. Like, there's not much point wasting anyone's time, or we could get it approved, but this is what we're going to need. This is the business case, or the individual case that we need to put forward to make sure that actually gets pushed through. Because I know you have clients that come to us with great disappointment that have thought they were able to get a loan only to have it knocked on the head when they've made that application. Yep. That pre-work is so important. The pre-work, the due diligence, understanding your own situation, and then being able to lay that on the table to someone like yourself that can put together and structure a deal that you know is going to go ahead is pretty important. It's pretty valuable. There's value in that. There's definitely value in having someone in your corner that can put together a deal.
Absolutely. Sure. And one thing I didn't mention before is about brokers. The other value proposition we have is that we don't charge for our service. Like, it's so wonderful that I've come from an industry whereby, when I left the car industry, it was you got paid on the margin you would charge over a base rate. So the better you got at your job, the more the person on the other side would end up paying. It's just not. I was really uncomfortable with that, Whereas a broker, we literally get paid by the banks to do what's in your best interest, and you don't have to pay for that service. So we often talk about how easy it can be too if you've got a pro broker. because it can take about an hour of your life with a broker to save years off your home loan. Well, it's one of the easiest investments you'll ever make in time, you know.
So just on that, so for those uninitiated, that hour spent, time saved, or dollars saved off your loan. What are the things that you can do with your magic wand as a broker that can actually help save people time and money off their mortgage over the life of their loan?
Yeah, so I'll give you a couple of examples. The hour I mentioned is from the moment someone calls us or me, 15 minutes later, we've worked out whether or not this is an application that's going to get approved. Pretty quick. Like, okay, this has got legs, we're good. And we book in a further chat, which is via Zoom usually. And in that interim, between the time they book that conversation and the time we catch up, we give them access to a portal. They drag and drop some documents in there. So it shouldn't take too long. And then during that catch up, maybe half an hour, by the end of it, we've picked a lender. We have done the application, close to finish the application forms, and then we submit it. So their job's pretty much done. What I meant by the years saved is that when a client comes to us, and let's say you have a home loan already, most people are I'm talking high 90s% of people are overpaying versus what they could get on the open market. And it's because they've been lazy on that, or they've gone direct to a bank, or they just haven't reviewed it for a while. So we would actually look at refinancing their home loan, and the difference in the savings of interest that they make could save them years off their home loan. And when I say could, it's a bit loose, but we have, I think the average refinance we've done the last 2 years, Jay, is a 3-year saving on a home loan. And you talk about money saved, like people always go, 0.1% is $100 a month or $50 a month, and it's going to take me hours. I can't be bothered for that. But the reality is that if they're not paying the minimum, they're paying a little bit more, then what's the minimum really matter to them? You know, so it turns into a saving in time. And most of the people that are too busy, and they're probably listening to this now, if they've hung in there long enough, but they're probably too busy to actually spend the time, even if it's an hour, to go to a broker and get it sorted, because they're working to pay off a home loan that they don't want. Well, I've got 3 years for you, you know, like, stop going to work.
What is it? Working a job you hate to earn money to buy things you don't need.
Impress people you don't like.
Yeah, that's it.
Yeah, so the time saved, that's what it is. It's investing some time into just getting it sorted at the start. Let us do our job, and you can save years. And we've recently refinanced, as a classic example. We've got we've got two real easy ones. So one of these clients we've got has a property loan worth millions of dollars, and they have a private banker. They called me and said, "Hey Lee, been following you on social media, and I just wanted to see, I think I'm getting ripped off by my private banker." And I said, "Okay, well, let me be the judge of that." He goes, "No, I'm pretty sure." So he gives me the rates they're paying, and I look at it and I go, "Yeah, you're getting ripped off by your private banker." So we did a refinance for this guy. Took maybe an hour and a half of his life, because he handballed it straight to his accountant anyway. He's self-employed. We did the rest of the work, and he saved $36,000 a year on his home loan. And here's the clincher. We used the exact same bank. He didn't have to move his banking. We used the exact same lender. So we refinanced this guy's home loan. He saved $30,000 a year, and we're using the same bank. And he had a private banker.
It's interesting that as a broker, many people probably don't understand. They think that if I want to refinance with the existing bank, I've got to actually go and do it through the bank, when you've got that option as well. You've got that opportunity to actually go and you've got a panel of banks and lenders that you can actually use.
Yep.
I think that's not commonly known amongst people looking for debt solutions.
No.
You just have to ask the question sometimes, don't you?
You do.
Ask the right question.
Or know where to go, which again is one of the reasons why it's good to do things like this, because a lot of people that are listening to this maybe don't have an understanding that maybe they're buying their first home, maybe they have only had experiences with the bank and never a broker, although again they're in the minority, as you said earlier. One of the other things we want to talk about, given the fact that the property market has actually been very good during this period of time, and probably unusually good considering what rates have been doing, you would normally think that property prices would taper off a little more than maybe they have. But one of the things that you mentioned, maybe off air or in the show notes, pre-show notes, was around hot topics with accessing equity. So people with existing properties that maybe have accumulated, their capital value is increased, and they've got equity to potentially invest. They've got maybe they want to do some renovations, or maybe they are restructuring because they're going to start a small business. Who knows?
Yep.
So talk to me a little bit about some of those opportunities that you have with people coming to you wanting to access equity. How do they do it, and what's the process that you would normally look at?
Yep. So a few years ago, you talk about property prices going up still, and the answer to that is purely immigration. But we've got record levels of immigration, people coming into the country at the moment, especially post-COVID, right? People wanting to come back in, and a lot of it's students, but they need somewhere to live. So what's happening is these people are buying properties as owner-occupiers, or they're renting. But at the same time, the Victorian government, for instance, has increased land tax because they've got to pay back the debt they've created through COVID, right? So there's all these taxes increases, and investors are going, I'm not doing this anymore, I'm out. So we'll go into state. So we're seeing a lot of that. So they're leaving the state. That means investor stock's not on the market. So people are going, well, I'm either paying these stupid high rents because there's no properties to rent because the investors are gone, or I may as well just make the leap and buy something. So you've got all these owner-occupiers popping up, and that's what's propping up the property market. And there's not as many stock getting built. So we've got less stock getting built, more people wanting to buy to live. Yep. Rents are up here, so it kind of goes, well...
Supply, demand, there's another supply.
So that's the reason, that's the only real reason. And the government's conscious of that. They turn off the immigration tab, you could be in a bit of bother. So back to your question about refinancing to release equity. So in the simplest terms, equity is really the difference between how much your property's worth and how much you owe, right? So that's the equity, the amount you've got left. And when we look at how much equity you've got that you can actually use, we just take 80% of the value of your property, and then the difference between that number and what you owe is how much equity. So an example is if you have a property worth $750,000.
I thought you were going to use a nice round number for
Man,
me. I'm not good with maths.
As it came out of my mouth, I was really...
You can backtrack now. Let's make it a
It's
mill.
$1 million for sure.
Show off my Mr. Ripley brain. All right. So if you had a property worth $750 and you owed, say, $500,000, right? So 80% of $750 is $600,000. So the difference between your $600,000, which is 80%, and $500 means you've got $100,000 there as usable equity. So we quite often do we do a refinance for somebody, save them money, remember, and also at the same time have access to another $100,000 they could use for insert use here. Renovations is a common one at the moment. That could also be capital to use as deposit, stamp duty on a purchase for a property, maybe an investment property. Could be managed funds, it could be anything really that is you just got to be a defined purpose.
Could be a buffer for future risk protection or risk mitigation in the event that you had a reduction in your income.
Yeah, well, Delta and I had conversations recently about clients trying to restructure, and we do that a lot, restructuring finance, because they've either gone to a bank or they've got it wrong, or circumstances have changed, so we'd have to restructure their financial affairs. And Delta, I've been talking behind the scenes about with regards to the amount of equity they have, how can we best use that? Because, I can access the money. Lending's the easy part for me. It's like, okay, we've got this much money we can access, but leaning on you guys, for instance, qualified professionals who can say, okay, we know your situation, we're the pros here, let us hold your hand and get this structure right. Find a home for that equity, because there's usually a better use for it.
Do people resist when you sort of point out to them that they can borrow more? Like, is there a sort of initial hesitation around why would I do that?
Yeah, so first of all, we normally don't go and lead in with, hey, you should take out more debt. A mortgage is serious business. Like, no one wants a home loan or a mortgage. I mean, the word mortgage means death pledge. No one wants that, right? So we don't encourage them to take out debt unless there's a reason for it that's going to improve the situation. And as Jay mentioned before, sometimes it's literally just creating a buffer to get them through this season. And it could be they're just having kids or about to. They're on mat leave, they need a buffer. So when we encourage them to when we talk about taking out extra debt, it's got to be a home for it that's going to improve their position, right? That's the first and foremost. So with that equity, if they are looking to buy an investment property and they're a bit nervous about cash flowing it, some of that equity could be used then as a buffer to protect them over those next few years, to get them through this season. So yeah, we don't encourage them to take out the money for no reason. It's only if it's going to improve the situation, and we don't want them to have to be a forced seller, especially in a downturn market if that happens. So yeah, it's buffers are really key.
It kind of speaks to understanding the why, like the purpose of those funds, and knowing a little bit more other than just get some more debt. It's what are you going to use it for? Have you got a purpose? Have you got a reason for investing that? How could you make more effective use of the equity that you actually do have? You mentioned something which is self-evident for those that know, but you mentioned 80%. Just talk very quickly about why 80% is an important number, important figure.
Yep. Okay, so the banks will essentially lend you up to 80% of the value because anything over that is deemed too risky for them, and you normally have to pay what's called lender's mortgage insurance if you do that. And not only is there a thing called lender's mortgage insurance that people hate paying when you go over 80%, but it's also usually attracts a higher interest rate, so it's not very favourable for people to go over 80%. So the banks have better interest rates and better deals. No lender's mortgage insurance if you go up to 80%. So some of the banks even have better rates to go under 80, like 70 or 60, it depends. And this is why you need to speak to a broker because there's so many moving parts. And 85, 90% might be the best option for you to get what you're trying to do, right? But 80% is just because lender's mortgage insurance and rates.
Lender's mortgage insurance sounds great, Lee. I'd love to have that insurance.
Yeah. Okay, so lender's mortgage insurance. Good. Thanks, Delta. So lender's mortgage insurance covers the lender, not you. And it's the only insurance policy I know of that you pay a premium and a big one to cover someone else. Yeah.
Is that a common misconception that it's to protect the borrowers versus the lender?
Yeah, well, it's funny because we don't do a lot of lenders' mortgage insurance loans anymore.
Okay.
And the reason for that is that most of the time that was first home buyers or owner occupiers. And with first home buyers at the moment, the government actually is guaranteeing those loans for first home buyers.
What a great segue into some of the schemes, the home buyer scheme. So you mentioned one there, the sort of guarantee scheme. Let's sort of run through the home guarantee scheme, how it works for first home buyers. What's on offer?
Yep. So there is limits as to how much you can buy, but let's just assume you fall within that. 750,000, I think, in Geelong where we're from. So if you buy a property as a first home buyer and you have less than a 20% deposit, that we just mentioned lender's mortgage insurance, traditionally you'd have to pay that and you would get a higher interest rate. Now, at the moment, the government is guaranteeing that home loan. So if you put in as little as 5% deposit, then our example before, 750,000, so you would need $37,500 deposit, and that's how much deposit you would need. The government will guarantee that loan. So there is no lender's mortgage insurance for you. So that's the home guarantee scheme. The government is going to guarantee that loan to the bank. And the other beautiful thing about that is that you pay interest rates as if you had a 20% deposit. So not only do you get no lender's mortgage insurance, you also get a cheaper interest rate as if you were dropping 20% into the deal, which for mine, that's why people aren't paying lender's mortgage insurance, because it makes sense. Now, that's also for people who've owned a property before that haven't owned one for 10 years. So quite often you'll get people who are, say, separated, trying to get back on their feet, new relationship, whatever, and we're talking 40, 50-year-olds plus saying, I haven't owned a property for so long, but I just don't think I can get back into the market. It's like, well, we got news for you. The government is guaranteeing that loan to get you back in. So.
Yeah, I wasn't aware of that 10-year time frame. As I'm just thinking about, as you're talking through that, people have separated. Unfortunately, we see a lot of clients that are in that position where maybe post-COVID, there's, separations are on the rise.
Yep.
And they're in a position where they need to be, securing housing for themselves. Mm-hmm. So extracting themselves from the family home is a pretty difficult task in this sort of lending market.
Yeah, I've got one at the moment that comes to mind. Separation, capital from family law settlement, looking to get back into the property market, but serviceability and the ability to borrow on their own steam struggling, need some support. The home guarantee scheme.
I know a guy, Jay.
Yeah, I
know. That's the first part of that scheme, is that the government will guarantee that home loan. So you avoid lender's mortgage insurance and you get a better rate. But then the government's also offering assistance for first home buyers for a while now, which is in the form of a concession on their stamp duty. So stamp duty is, for first home buyers listening that don't know, it's just a government tax. It's a state government tax, or a transfer tax, if you like. So that tax essentially is paid for you to transfer the property into your name. And there are limits to how much you can buy a property for if you want that waived to $0. But example, we'll give you an easy one now, Jay. So if you buy something for $600,000, Stamp duty would be about $30,000 for all of us at the table if we've owned property before. 30 grand. But if you're a first home buyer, it's zero. So you'll save the 30,000. You save lender's mortgage insurance in our example before. So really, the whole thing you need to do is come up with that 5% deposit, and you could really just be getting the keys to that home. So, but I'll caveat that there is a cap on that too. So you can't just go and buy a place for $1 million and get no stamp duty. You pay a full whack at that. So it goes up in stages till about $750. So you'll get pretty much no discount at $750.
So considering the rental market at the moment, there might be people in a position where potentially their rental is costing them more than what a mortgage might cost. Would that be fair to say?
Not quite, not yet, Delta, because we talk rental yields are around 4 to 5% at the moment through most cities. So that means that your tenant, as a tenant, you're paying about 4 or 5% on the value of the property, whereas interest rates being sixes. So there's that difference straight away, which is about 2%. But then you've also got the fact you want to pay down the home loan at some stage. So you've got principal as well to pay.
Yep.
So the payments are a bit different.
Yeah.
So.
Now, mindful of time, would you believe we've been going for nearly an hour? Would you believe that?
Wow. No.
Time flies when you're talking
We'll have to
mortgages.
clip it and truncate it. It's just the 3 things I said that are valuable.
Well, let's finish on 3 things. I will actually, before we do that, for those people out there listening to this, how can they find Lee at Fidget? Where can they find you on the interwebs?
Yeah, so on socials, Instagram and Facebook, we're at Fidget Finance. That's where you'll find us. You'll also find a pretty quirky series we did on Monopoly. So check that out. Just basically my brain goes there about all the things I learned from Monopoly over the journey in property. So,
and 115 plus 5-star Google reviews. They can check you out on Google and see that you're legit.
Yeah, and if you like this, 5 stars, please, for the brilliant podcast. If you don't, just don't click on it. If you give 5 stars to an Uber driver, surely you can give it to me, right?
Yeah.
Yeah, that's what I thought.
I think that's fair enough. All right. Top 3 tips to anyone. It doesn't have to be 3. It can be 1. The top 3 tips to someone actually. Let's say it's a first home buyer.
Mm-hmm.
A first home buyer. What are your top 3 tips to them in getting themselves in order to go and get finance?
Yep. Okay. Would be make sure you know how much it's going to cost you, deposit. You know how much out of pocket you're going to need. So ask your broker. The other one is just make sure you have your finances in order in the first place. And what I mean by that is if you've got any consumer debt that's nearly paid off and you can get rid of it, you would do that. So I would say, get your finances in order. Definitely find out how much deposit you've got to access, and then, of course, find out your borrowing capacity. But most of those things that you can grab from your broker.
I was going to say, see a broker. Number 1, see a broker. Number 2, see a broker. Number 3, I think financial advisor's in there somewhere. But
yeah, that's it.
Cancel all your streaming services too, isn't it, Lee? Isn't that one of the things that you need to be looking at?
Well, that's discretionary. We can work around that, Delta. So, I mean, that's the thing. Most people would say that if times got tough, they're not going to let their house get repossessed because they wanted to go to bean squeeze. You know what I mean? Like, you just wouldn't do it.
Yeah.
So it's a very easy conversation in our notes to banks. So first home buyers, man, that's a whole nother podcast, Jay.
Yeah. Any other tips? Anything else we haven't asked you? There's lots of stuff we haven't asked you, but we'll definitely have you back on for a second and third episode. Is there anything else? Any other closing comments or calls to action for our listeners out there?
Yeah. So I mentioned the Monopoly series before. The biggest lessons from that: invest early, invest often. So in the game of Monopoly, you go around the board, and if you sit still, you're in problem. And if you just keep going around collecting your salary and not investing, then you'll get to the end of the game and it's not going to end well because you don't have any investment. So invest early, invest often. If you do have a home loan and you haven't reviewed it for a year plus, then get in touch with us or your broker. We do annual reviews for our clients proactively. So you'll get a phone call saying, hey, good news, your rates come down. If you haven't been having those conversations with your broker or bank, then yep, you need to. So that would probably be it. Invest early, invest often. And if you've got a home loan, you really should be reviewing it annually with your broker.
Beautiful. Lee, thanks again for coming on. I know Delta has appreciated the decade or so that she's known you, and the support that you've given us over the most recent time with some clients, and look forward to many more client interactions over the coming weeks, months and years. So thanks again for coming on.
Thank you. Thanks,
Delta,
guys.
thanks for joining us today.
Thanks,
and,
Jay. Thanks, Lee.
Thank you.
We'll see you next time. Cheers.
Right, cheers.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility. Do your homework. Ask questions and speak to an actual human that knows what they're talking about before you do anything.
PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.